YouTube, and social media at large have destroyed an entire generation of up-and-coming traders by pushing ridiculous pipe dreams, bro science, and sensationalized anecdotal evidence that couldn't be replicated in 10 lifetimes. They not only have unhealthily warped the expectations of retail traders, they also have pushed them to take insane and unsustainable risks to emulate what trade influencers have told them to look up to. The results of this instant gratification shit show of epic proportion is a generation of meme coin-infused degens going all in on every trade, and hordes of new traders that have essentially traded their cluelessness about long-term risk management for the bragging rights of 9% monthly returns, while their next margin call is lurking in the wings of the next market downturn. The social media trading swamp will need to be drained at some point, and it will start with realigning retail's expectations of riches with reality. That is the first step that this video intends to make, and it will be demonstrated 3 different ways. So let's start here. Anyone can produce a flash in the pan for a few months. From a statistical standpoint, that is actually a very probable outcome. Where the divide is made between newbies and real traders, though, is when a trading strategy is put through the grinder of a prolonged and adverse market configuration, like the ones we had here, there, and there. Those phases are where gambling stops and trading starts, when risk management takes precedence over rates of return, and as the saying goes, when the tide goes out and unveils who was swimming naked. There is only one playing field within which what can be achieved in trading can truly be revealed, and that is through longevity, meaning either in terms of years of tenure or in terms of statistical significance. And survivorship is the first filter allowing us to separate what's real and achievable from the nonsense pushed all over social media. That is called the grid, Collective 2's matrix of active trading strategies. For those of you who don't know, Collective 2 is a platform where independent traders and trading system builders can both build a third-party audited track record and sell their trading signals on a marketplace. Execution protocols have been improved over the years to make sure that these signals are replicable by applying sound industry standards as far as liquidity management. So we're not looking at anecdotal BS here. The platform has seen literally tens of thousands of strategy managers over the years, most of which started off to the races with insane returns and obviously attracting most of the subscriber base like moth to a flame. Then over time, market reality set in, and most of these strategies today are gone and went bust because of poor risk management, along with the capital that their subs allocated to them because obviously they equated parabolic returns with performance. So to gauge what sustainable returns really are in the long run and ascertain the fact that risk management cannot be skipped, we can use the grid to screen for survivorship out of the 1,000 strategies still active on the platform today. In order to do that, we will ensure that the study period covers at least the 3 significant market downturns that were illustrated earlier. That way, we will screen for those strategies that could withstand the brutal sell-off of late 2018, the panic-induced COVID crash, and the 1-year Fed rate hike market meltdown. To do that, I used a tenure filter of a minimum of 8 years, or about 3,000 days. Then my second filter applied a positive cumulative return, obviously. As you can see, these 2 filters alone already weeded out 979 trading systems out of the 997 of those available in the database, leaving us with the most reliable 1.8% of them all. Considering the historical number of strategy managers as displayed on Collective 2's website's landing page, those 18 systems are also the top 0.034% of all strategies ever released. If you're still enticed with 70% annual returns, let that begin to sink in. Now let's screen for maximum drawdown. After my many years in the asset management industry, I know that in the vast majority of cases, most investors can tolerate typical drawdowns ranging from 10% for the most conservative investors to about 30% for the most aggressive ones. But for the sake of this study, I'm going to be extra lenient and discard all strategies with a drawdown in excess of minus 50%. Once again, I cannot stress enough that minus 50% is extremely lax by any industry standards. Remember, to make up for a 50% drawdown, you must generate a 100% return. For most people, that goes way beyond their risk tolerance, as it probably should if you are serious about trading and investing. So really, I cannot get much more generous than that by applying a minus 50% drawdown limit. That extra filter now leaves us with 11 strategies. Remember, we barely applied 3 basic reliability filters here. They weeded out 98.9% of all available systems, you guys. See where I'm slowly going with this? So now we've taken care of tenure, long-term returns, and peak risk. It's finally time to look at the average performance of this elite pool of systems. The average compounded annual growth rate before fees of this tiny pool of trading systems is precisely plus 13.4% for an average max drawdown of minus 29.5%. The average long-term MAR ratio is therefore 0.454 with an average leverage of 1.1, that's 10% leveraged. So normalize for a leverage of 1 so that we can compare apples to apples with the S&P 500 in a second. That would leave us with these normalized stats. Obviously the MAR ratio doesn't change here because actual performance is a fixed ratio and never a function of leverage. Which is why I will keep beating that dead horse into you every chance I get that performance is never returns alone but risk-adjusted returns. You see, this picture right here is a first reflection of the reality of actual long-term, third-party audited, best-case scenario trading results of independent traders. Over the past 3,000 days as of making this study, the S&P 500 generated a compounded annual growth rate of plus 14.4% and a maximum drawdown of minus 35.4% with no leverage obviously. That's a MAR ratio of 0.46, which is 10.5% worse than the average of the subgroup that we filtered in. Also, let me stress the caveat here that this comparison happens to be extremely favorable to the S&P 500 index since its risk-adjusted return was one of the best it's ever been over the past 3,000 days. If we segregate the 3,000 days prior to that, then its average compounded annual growth rate for the period was plus 7.8% with a maximum drawdown of minus 57.8% reached during the subprime crisis. That's a MAR ratio of 0.134 or 3 times worse than the 0.46 of the past 3,000 days. Lastly, without nerding out too much on the stats here, depending on your strategy, if the return offered by a particular strategy did not satisfy you for any reason, you could easily leverage it a bit to normalize it for market risk and hence beat the S&P 500 on return alone by taking the exact same risk. Many of these strategies are trading with a significantly lower leverage than 1, many times by a difference of 10% or more, so leveraging would not be an issue. But let's not digress too much here and move on to our second reality check. Let's observe what headhunters are looking for. This is DarwinX, a platform that seeks to connect trading talents and investors under their own regulatory umbrella. By listening to what YouTube gurus have to say and all the hype about those scammy online prop firms, you would think that what DarwinX would be looking for is sky-high returns, right? After all, the definition of performance for most people is the rate of return, am I right? So let's do away with my obsession for risk management here for a second and let's see how they go about it. First of all, how interesting is it that this professional and regulated platform too looks for nothing but certified track records to vet traders. Funny how live trading sessions, logging into an account in a YouTube video, or quote-unquote showing a broker statement do not qualify as sufficient proof of trading performance, huh? How interesting. But let's keep reading. The competition for capital is fair and balanced as we standardize the risk of all track records. How about that? So you mean to tell me that normalizing performance for risk is all that truly matters? Well, of course it is. As you can see, rates of return alone mean absolute jack when it comes to evaluating performance. There's no mention of rates of return anywhere here. Hyperventilating about rates of return on you is what clowns do and how you get fooled. So why is risk normalization so important? Because as we saw it earlier, survivorship in trading is a major issue. And observing now their pool of curated traders and what their performance really is will prove just as much. DarwinX goes with their own proprietary index by rating traders with what they call a synthetic Darwin score that blends 12 performance attributes. So in the following chart, I added the top 20 best strategies by Darwin scores among what they call their good score cohort, which filters for only those accounts with a good grade combination in their 12 investment attributes, excluding capacity. I then removed the bottom 9 lower outliers by Darwin score in order to get to a short list of 11 names comparable to the sample size that we got from Collective 2 and show the best case scenario in terms of long-term performance expectations. Each strategy was then equally weighted in the backtest with the same allocation. The backtest started in 2016, exactly 3,000 days ago, similarly again to the filtering that we applied in Collective 2 earlier. And here here are the stats. As you can see on the chart, the cumulative returns range from an average of plus 54.7% to a minimum of plus 8.8% to a maximum of plus 280.2%. In annualized terms, we're talking about plus 4.5% average returns, plus 1% minimum, and plus 17.6% maximum. Unfortunately, this backtest does not allow us to see the drawdowns and normalize for it, but we know that the screening for risk was already done for us thanks to the due diligence process that they disclosed. So does it look to you that any of these top traders can turn $1,000 into millions in a matter of a few months, or can even routinely generate 60% annualized returns and survive long term? That is the reality check that I want you to make. Last proof to drive the point home here, and we're gonna stray a tiny bit away from the scope of this video, but I believe this is worth it. Aside from independent traders, can the industry itself, with all their intelligence and resources at their disposal, can it beat the standards of performance that we just witnessed? They should, right? Especially the best of them all. Well, let's check it out. As benchmarks, we're going to use a best-in-class all-weather fund that has been rated 5 stars by Morningstar for the longest time. I'm talking about the T. Rowe Price Capital Appreciation Fund, ticker PRWCX. This fund is so good, in fact, that it has been close to new investors for years now, and Morningstar ranks it in the top 5th percentile over 5 years and top 1st percentile over 10 years by trailing returns. Guess what average compounded annual growth rate this fund returned over 5 and 10 years? Here we go. About 11.4%. And with what maximum risk? Minus 16.5%. That's a MAR ratio of 0.69. But let's take a look now at another 5-star Morningstar fund. Only this time, an investment vehicle from the staple hedge fund, namely the AQR style Premier Alternative Fund. For those of you who don't know AQR, it is a hedge fund that blends fundamental and quantitative analysis based in Greenwich, Connecticut. Over 10 years, this fund is positioned again at the top in the 6th percentile of its category to be exact. Over the past 5 to 10 years, we're looking at an average annualized return of about plus 7.6% and a max drawdown of minus 39.6%. That's a MAR ratio of 0.19. For reference, over the same period, the S&P 500 returned plus 13.3% with a max drawdown of minus 35.4% reached during the COVID crash. That's a MAR ratio of 0.375. So there you have it. After reviewing the best that trading performance can offer long term, you now have an objective, proven, and quantifiable estimate of what real and replicable trading performance actually is, far from the grotesque fantasy that YouTube phonies want to have you believe. I hope now that you realize how laughable those 50+% annual returns touted online really are. In fact, anyone bragging about those is literally telling you that they are planning on getting a margin call at a later date. The ballpark bottom line is this: by taking a maximum risk similar to what the S&P 500 offers, you will typically be able to generate annual returns ranging from 10 to 20% as an independent trader. From there, leverage is your own choice depending on your own risk aversion, but that best case 10 to 20% compounded annual growth rate per unit of peak market risk is likely going to be the realistic range that you can expect if you do not wish to gamble away your lifelong build trading capital base. Scale that to your chosen leverage, multiply it by your trading capital, and you will get the kind of cash that you can expect to make long term from trading. If there is anything that I want you to take away from this video, it is this: your only job as a trader is to distort in your favor the reward to risk ratio offered by a passive investment in the market. That means using active rebalancing to generate a higher return for the same risk or a lower risk for the same return. Once that mission has been accomplished, all you will have to worry about is build up a capital substantial enough that those 10 to 20% annualized will allow you to generate between $100,000 to $300,000 annually while living your life in your own terms. That will be demonstration made in an upcoming video where I will reveal to you with a third-party audited track record to back it up how that is being done in a large, real account for real profits with tight risk control to know that I will be making it until tomorrow to fight another day. I will catch up with you then.